TikTok is not really a good place for learning to take place. Customers may not be able to pay you back and divided by the number of years. Hey everyone, this is Creditmelater over here. So this is my first YouTube video. I decided to try YouTube after doing TikTok for a good amount of time. I still feel that TikTok is not really a good place for learning to take place. It's a rather distracting platform. So here is me on YouTube with my first video covering the top 10 confusing terms for principles of account. Gross profit basically means the amount that the business actually earn from selling goods. So it's basically consists of sales revenue, the amount they earn from selling goods, and the cost price, which is represented by cost of goods sold or cost of sales, is basically the amount that they earn from trading of goods. Whereas for profit, or you call it profit for that period, actually refers to the amount that the business actually earns, as the amount that we use the gross profit and deduct it against the expenses like rent expense, salaries, electrical bills like utility expense, and we get the actual amount that the business actually earns, which is profit for the year. So in short, gross profit refers to the amount the business earns from goods, whereas profit is from everything. Next up, we have prepaid expenses or expense payables to expenses, whether they are paid for already, whether it's being incurred already or not. And when we mention incurring or expenses, it basically means whether the business has actually already spent or used a particular services. So if let's say your business has actually used cleaning services, right? We can say that the business has already incurred cleaning expenses, and regardless of whether it's already paid for or not, it has to be recorded. So I feel that a good example of prepaid expenses would be your EasyLink card, where you have to top up the card before you actually use it, or things like your YouTube Premium subscription, where you have to pay for the next month's subscription before you even use the services. Good example of expense payables would be like your utility bills, where you have to use a certain amount and the utility company actually bill you the following month. So you use first before you actually have to pay for it. Next up, we have trade receivables versus trade payables. To put it simply, trade receivables is the amount that the business can actually receive back from their credit customers, or the amount owed by the credit customers. Whereas trade payables, right, is the amount that the business owe to the credit suppliers. In short, right, there's this shortcut where you can remember by when the business sell, okay, they can record trade receivables. They sell on credit, trade receivables. If they buy on credit, then you record trade payables. So depreciation is where they incur a portion of the value of the non-current asset. So example, this is a non-current asset. They will incur a portion, okay, 1 portion, 2 portion, 3 portion, 4 portion, 5 portion for a non-current asset of 5 useful life years. So every year they incur 1 portion as expense. Whereas if let's say after 2 years, the accumulated depreciation should be 2 portions, because let's say 1 portion for 1 year, accumulated depreciation after 2 years should be 2 portions. The remaining value of the non-current assets, which is known as net book value, will be 3 portions. Accurate depreciation 2 portions, net book value 3 portions. Allowance for impairment of trade receivables, or known as doubtful debts or bad debts, is actually a subset of the whole circle, trade receivables. Okay, so the whole circle can be known as trade receivables, where allowance is an amount, okay, that is estimated to be likely to be uncollectible. I know it's a mouthful, so you can also understand that it as the amount that the customer maybe cannot pay back, the 5%. So the amount that the business can actually confirm that they can receive back is 95% of the trade receivables, whereas 5% of the trade receivables is known as the allowance. In short, basically it's the amount that the customers maybe cannot pay back due to financial difficulties, or basically economy is not doing well. Some customers may not be able to pay you back, and you record a certain allowance, a percentage of the trade receivables. So capital expenditure refers to the cost to buy and to enhance the non-current asset, whereas for revenue expenditure, it refers to the cost to repair, operate, or to maintain the non-current asset. So in short, ROM. So things like petrol, okay, of a car to keep it running is revenue expenditure. Okay, if let's say I upgrade the tires of the car to make it operate more smoothly, that would be considered a capital expenditure. So what's the difference between long-term borrowings and current portion of long-term borrowings is that they are the same thing, or should I call it same item. Long-term borrowings can be a loan that is repayable within the next 5 or say 10 years. Okay, let's take it to be 5 years. So current portion will be the amount that the business has to repay off the liabilities, repay off this loan in the next 1 year. Whatever amount that the business has to repay within the next 1 year will be considered current portion. In short, right, current portion can be understood as the amount of the loan divided by the number of years. So it's always a constant amount no matter which financial year the loan is at. So that's all. This is my first YouTube video. Do give a like if you think this has helped you in the understanding of POA. That's all.